If you've been around the crypto space for a bit, you must have heard of the 4-year cycle before. This is the well-accepted theory that Bitcoin's price moves in 4-year cycles consisting of a 2-year bull market, then a 2-year bear market, then rinse and repeat. But recently I've seen a lot of debate about this being the last 4-year cycle, and that Bitcoin is not going to move so predictably in the future. If that's true, we may have to change our investment strategies. So in this video, I want to explore this theory, touch on some of the arguments supporting it, and share my view of what price action may look like in the future if not for 4-year cycles. If you're curious about any of this, then you're in the right place. Strap in, my friend, and let's dive right in. So I was browsing crypto Twitter lately when I saw Willy Woo, an analyst that I respect, make a bold claim that this will be the last 4-year cycle for Bitcoin. I stopped right there and did a double take. I was like, what? How can that be true? And it wasn't just him. A lot of other people on that Twitter thread agreed with him. I was really confused and curious because Bitcoin cycles have been happening like clockwork so far, which is why I had to dig further. And if we take a step back, the prevalence of cycles is super important because many of us are basing our investment strategies on its existence. I hear a lot of people say, oh, we're gonna sell when the bull market is about to end and then buy back in the deep bear market. But what if it doesn't play out like that and we're left sidelined instead? So that's why I wanted to dive deeper into this theory right now while we're arguably still mid-cycle, and see what to make of it. Okay, so if we look at this chart of Bitcoin's price with its halvings marked, you can kind of see the cycles. There's a bull period, followed by a bear period, and then accumulation period leading into the next cycle. And these price cycles make sense because Bitcoin's halvings are programmed to happen every 4 years. That's just when the amount of Bitcoins that miner receive per block is cut in half. Why does that even matter though? Well, it has to do with basic economics. Because Bitcoin's price is a dynamic equilibrium between a few factors. 1, demand from sat stackers who buy periodically regardless of price and hodl. 2, demand from everyone else, day traders, tofu-handed investors, and so forth. 3, the supply coming from miners who have to sell in order to pay their bills. And this is new supply that they get from block rewards, by the way. And then 4 is elasticity. And that's just a fancy way of saying, how does price going up affect how willing people are to sell some of their Bitcoin? So we got all these factors coming together to drive the price, and they're just chilling, having a good time. Then the halving comes along and affects factor number 3 by cutting that supply from miners in half. And if demand stays the same, there's now a supply shortage. And that's a big deal because you can't just create more Bitcoin like you can go mine more gold to satisfy any shortage. So the only way for supply to emerge to satisfy demand is if price goes up to a point where some holders are willing to sell. And here's the fascinating part about Bitcoin. It is special in that as the price rises, it actually attracts more demand. This is different from normal, right? Usually when a store raises their prices, we're like, nah, not gonna buy anymore. But for Bitcoin, we've seen this many times before. When it's rocketing, our friends are hitting us up because they feel the FOMO. So this characteristic plus the halving induced supply shortage causes the price to rise faster and faster until we reach bubble status and a blow off top. Then we have a crash afterwards, and it takes time for the market to find a new equilibrium before repeating the process all over again. This really makes intuitive sense to me, and it's happened pretty reliable so far. So why are people arguing that this won't happen anymore in the future? Well, a huge reason has to do with the halving and its decreasing influence over time. Because remember, the halving causes a supply shortage which drives the price upwards, assuming demand stays roughly the same. But in the future, the yearly issuance rate of new Bitcoin becomes a teeny tiny percentage of its overall supply. Like in 2016, the halving reduced the annual number of Bitcoin issued to 650,000 per year. That is just 3.1% of the total 21 million coins that is Bitcoin's hard cap. And in 2020, that got cut in half, so 325,000 coins at a 1.5% rate. And in 2024, that's going to be 162,500 coins per year at a 0.77% issuance rate. You see how the percentage of new Bitcoin issued relative to its total supply is already going to be minuscule by the next halving, here's a great chart by Geert Jankap, which can help us visualize this concept. You see how the relative supply shock caused by each halving since 2012 drops immensely? So it makes intuitive sense that while previous halvings could drive Bitcoin's price in these 4-year cycles, we can't expect it to happen forever, especially with the change in issuance becoming super tiny by the next halving. And as a quick thought experiment to understand this point better, we can think of how Bitcoin will have a ton of halvings until the final Bitcoin is mined in the year 2140. That's when the miners won't rely on block rewards anymore to make money. Instead, it will all just be from collecting transaction fees. So at that point, and even well before then, we can't expect the halving to play any effect whatsoever. It would make no sense for Bitcoin's price to follow a 4-year cycle at that point. And we can just extrapolate that conclusion forward and conclude that the 4-year cycle is likely to stop sooner rather than later. That should not be surprising though. The cycle just happened 3 times so far and we're on our 4th one. From a statistics perspective, that's not a statistically sound trend at all. It's only 3 freaking data points after all. And this whole thing kind of reminds me of the famous saying, past performance is no guarantee of future results. But in this case, past 4-year cycles is no guarantee of future ones. Now, if we zoom out from this whole talk about halvings, we'll see that the landscape for Bitcoin has also evolved drastically in the past few years. And that's another huge reason why we shouldn't expect for the same 4-year cycle to continue playing out in perpetuity. Bitcoin is not some small pond for techies and libertarians to play in anymore. It's a huge ocean now with big whales like institutions and nation states entering. I mean, it even surpassed a $1 trillion market cap earlier this year. And there's a real compelling argument to be made about why this time it's really different. Like, we have much better on-ramps these days, and it's not only Coinbase, but also PayPal, Venmo, Robinhood. There are so many options to choose from. As for the macro backdrop, we just had a global pandemic and unprecedented money printing by central banks around the world. So much so that even big players like Ray Dalio and Paul Tudor Jones bought some Bitcoin, as well as institutions like MicroStrategy and Tesla. We even saw Bitcoin's narrative of digital gold play out in real time when some funds straight up admitted that they bought Bitcoin instead of gold. Now, I definitely glossed over a lot of these points that make up the case for why this time it's really different. But basically they form the crux of the supercycle theory popularized by Dan Held. And I made a video about that in case you're curious. I'll leave you a link down below and at the end of this video. Now hold up for a sec, because there's one more fascinating reason for why this may be the end of 4-year cycles. And it actually has to do with Ethereum, because ETH used to be like all other altcoins, comparatively small and largely dependent on what Big Daddy Bitcoin was doing. But now ETH has started to blossom in its own right with over a $300 billion market cap and a pop in DeFi, NFT, and token ecosystem. Here's the thing though, ETH does not have halvings programmed into it like Bitcoin does. So there's really no reason for ETH to follow 4-year cycles. It only moved in that way in the past because that's what Bitcoin did. But as ETH starts to break free from Bitcoin and write its own narrative, we may see drastically different price action play out. And that interplay between Ethereum and Bitcoin is what might change Bitcoin's cycle, since we can expect money to flow back and forth between the 2 largest ecosystems, and that's going to affect things. Now, before we get to the question of what might Bitcoin's price action look like if not for these 4-year cycles, there's something I gotta address here, and that is, what if we keep seeing 4-year cycles because it's a self-fulfilling prophecy? Like, investors expect it to occur, so they start selling in anticipation of the upcoming bear market. And by doing so, they cause the bear market to begin, and then they start buying again after accumulation, and that drives us back into the bull market. I mean, this is definitely plausible because just look at the Pi Cycle top indicator. I was calling that a complete meme and a joke of an indicator because it's literally 2 arbitrarily chosen moving averages, and when they intersect, it has perfectly marked the previous tops for Bitcoin's price. And when it crossed again in early April, when Bitcoin was around $60,000, I was looking forward for that to be proven wrong. But lo and behold, we dropped to $30,000 in the following months, and it seemed like that Pi Cycle indicator worked like voodoo magic once again. One theory is that enough people believed in it that they sold and drove it to happen. I don't know if I buy that, probably just another eerie coincidence. But self-fulfilling prophecies are a real thing, so it could be true. Now, you are probably wondering, if the 4-year cycle's over, What would it look like instead? Well, it definitely does not mean we'll enter a forever bear market or go sideways for a long time. That is not what analysts are saying, at least. The first theory is that we could enter a supercycle. This is when Bitcoin really starts to take off and heads towards $1 million per coin, with very few corrections in between. This is the world where money printers continue to brrr, and institutions and nation states start gobbling up Bitcoin in droves. The second theory is that we'll still have similar cycles, but it just takes longer and we have less volatility than before. So less crazy gains, but also less brutal bear markets. I'm not opposed to that, to be honest. And the third theory is that Bitcoin will move more like gold or the S&P 500, which will have their own cycles that depend on a lot of different factors. Whatever the case may be, we know that eventually Bitcoin's price will be driven by mostly demand and not by supply shocks from the halving. I love this because we're still early on in the adoption curve, right? Remember this graph comparing Bitcoin's adoption to the internet? So there's still a lot more people for Bitcoin to reach and a lot more room for the ecosystem to expand. And that growth will bring more demand, which will increase the price. By the way, if we stop having 4-year cycles, that means the popular stock to flow model by Plan B will also break, because that model is completely driven by the 4-year halving event. Personally, I'll feel super vindicated because I made a video about why S2F model is wrong and people were bashing me about it. If you're curious about why I hate the S2F model, you should watch my video right here and also my Bitcoin Supercycle explainer video right here that I mentioned earlier. Anyways, I'm Kevin from BFB. I hope to see you on the next one, and cheers!